Hi, Kyle Frost here, independent Australian financial advisor hoping to use my experience to put out valuable finance content in a more detailed way. Franking credits are one of those financial buzzwords and often misunderstood what they are and how they're beneficial. Today I thought I'd go over what they are and how they work. Effectively, what a franking credit is, it's a reflection of the company tax that a company has already paid on its profits before it distributes it to shareholders. A way to think about it is think about it that you're the company and at the end of the day you're taxed on the profits before tax as if you were the company, so the profits are effectively taxed at your marginal tax rate. There's a mechanism in between that where obviously there's kind of a timing delay where the company pays its tax at 30% and then it distributes that. So when it comes to you, when that dividend eventually comes to you, it's a franking credit. It's a credit, as the name obviously suggests. It's the mechanism to make sure that you're taxed as you would otherwise be if you were that company. So what I've done here, I've just created a presentation and I'll just go through it. So you can see here as an example. So let's think of nice round numbers, obviously. So ABC company, and it has a net profit before tax of $100,000. Then if we go to the next slide just here, we can see on $100,000 at 30%, a company would pay $30,000 on that. So after the tax is paid, there's $70,000 that's remaining. All of that $70,000 that gets distributed to all the shareholders as money after all the tax has already been paid. Then obviously let's say that there's 1,000 shares in this particular company. That results in a $70 dividend that each of those shareholders receive. So that then if there was no such thing as franking credits, and franking credits are somewhat unique, it's not entirely unique to Australia, but it's not as prevalent overseas. If there weren't franking credits, what would happen is that $70 that would go on your taxable income. So it's effectively double taxation because the company's already paying tax, they give that to you and then you get taxed again if that was taxed at your 34.5% marginal tax rate or 47 if you're in the highest marginal tax rate. That would obviously not be an ideal outcome. So what franking credits does effectively, so you get your $70 dividend, and then if we go with that $30,000, just jumping back to the previous slide, there's $30,000 of tax that was paid, divided obviously between the 1,000 shares, so there's a franking credit of $30. So what actually happens, using a real life example in terms of like how the calculations actually work. So let's say that you received a dividend of $700 and there was dividends attached to that of $300. So here's, I guess, three individual scenarios. So a retiree who might be in pension phase and they pay 0% tax, a normal employee who might be on a middle income at 34.5 marginal tax rate, and then obviously a high income earner who might be in the 47% marginal tax rate. So that then on that $700 with the $300 franking credit, $1,000 actually goes onto your tax return. So if you earn $100,000, it's now $101,000 after accounting for that dividend. And then that's taxed as though it normally would be. And then you get that refund, that credit is from the previous slide, and that's deducted from your tax. And it's actually a refundable tax offset. So that in this situation, if you are below 30%, you will actually get a refund. So if you're on 0%, you'll get that $300 refund so that you get all of the profits effectively. Whereas if you're above that, you'll pay a slight amount more, so $45 in this situation. And then obviously in the higher marginal tax rate, they'll pay $170 in that situation. So if I just jump over to a calculator here, which you can get in touch and I'll share it with you just to, I guess, help you understand how it might apply to you. So if there's a dividend, you can understand like, well, what's actually going to be the tax payable after accounting for obviously the franking credit. And similarly, quite often when comparing portfolios and trying to understand the yield of the portfolio, I'm obviously working in percentages. And so here you can also just like put in a percentage and understand, well, what's the gross yield of that after accounting for the franking credit. So that's handy when you're comparing investing in Australian shares as opposed to a bank account or international shares, just to understand on an apples for apples basis what the after-tax impact is going to be. So just jumping back to this slide and other points to consider from the calculator as an example to understand like, well, what's the actual impacts of that. So A200, which is a popular Australian ETF, has a 12-month yield of 3.7%, and that's 80% franked. So what that means is that becomes a 5% yield. So not all, I guess, Australian shares pay 100% franking credits, and certainly as a result of that, all, I guess, distributions from Australian ETFs or Australian managed funds, they're going to be partially franked at 80%. So that just changes the equation. So it's still great, obviously, just not as good as at 100%, obviously. And quite often, another point, like who's it good for? Quite often you do get opinions out there where someone will say, well, franking credits are really really good for pension funds because you get the refund, or some on the other side they'll say it's really good for people on the highest marginal tax rate because it reduces the tax. I would say it's good for everyone. It effectively just gives the end outcome to what it otherwise would be. I think as an example why people might like the refunds, I guess it feels better if you get something as opposed to if you save something. So if you were to find $5 on the street, you probably feel better about that than if you save $5 on your groceries, for instance. So sometimes people just like obviously getting that money in their bank account. A couple of other things just to quickly consider. So there's a thing called the 45-day rule. So you've got to hold it for 45 days, otherwise you don't get the benefits of the franking credit. So that's a thing called, it's kind of a loophole that the tax office is doing to avoid a thing called dividend stripping, where you kind of collect the franking credit, but you're not actually exposed to the share. And probably just the last thing to consider. So as good as franking credits are, like I don't think it would make it a good idea to go 100% into shares, for instance. So you still obviously want to consider diversification across your portfolio. So if you're in 100% shares, Australian shares, you're probably under diversified, and it's probably a good idea to have, it's definitely, I would say, a good idea to have international exposure. So thanks so much for watching. If you'd like a copy of that previous sheet, let me know and I'll shoot it through. If you have any questions or feedback or suggestions for future topics, put them in the comments and I'll reply. And if you'd like more content like this, please subscribe. I'll see you next time.